In this third video for partnerships, we will continue our work on income allocation. If you refer to the handout and looking at example 5, another income allocation example, assume that AB company has net income of $32,000 for 2014. The partners L. Arbor and D. Barnett share net income and net loss equally. Drawings for the year were Arbor $8,000 and Barnett $6,000. This question is based on an example in your Principles of Accounting textbook. Part A asks us to prepare steps 3 and 4 of the closing journal entries for the partnership. So closing journal entries have 4 steps. The first one is to close revenue, the second is to close expenses, the third is to transfer the net income or loss to the partners. That's one of the steps we'll be doing. And the fourth is to close the drawings accounts. The closing of these accounts is necessary because these are temporary accounts, drawings, for instance, revenue and expenses. The third step is more about allocating the net income or net loss to the partners, and I'll demonstrate how that's done. And then in B, we have to prepare the partner's capital and drawings T accounts, assuming certain beginning balances. So let's go into a workbook and begin the process. So over here I have a space for the income allocation, then I also have space for the journal entries, and finally I have some space for the T accounts. So we need to allocate these amounts to the partners. So it's easier if we just say Arbor, Barnett, and total. This is not going to be a difficult allocation because when we think about it, there's really a 50-50 split, right? So if we think back to the question, it said that the partnership had $32,000 of net income. So all we need to do is split this net income. So it's 50-50, so 32,000 divided by 2 is for Arbor, the same thing for Barnett, and in the end we have the total is 32,000. So we know we've done the allocation correctly. Quite basic. Now in the next step, we'll do the journal entries to actually transfer that income to the partners. From our previous video, you know that the account that we will use with this transfer is income summary. The income summary account gets debited with a total amount of 32,000, and then each partner gets allocated his or her share of the amount. So Arbor's capital will increase on the credit side by 16,000, and then Barnett's capital will also increase on the credit side by 16,000. Let me indent my credit so that it can be according to convention, and this is just the transfer of net income to the partners. And in the next journal entry, the fourth of the closing journal entries, we will close out the drawings account. And the way that works is that since drawings has a debit balance, in order to close that account or zero it out, we will credit drawings and the debit goes to each partner's account. Why debit the account? That's because debits decrease the capital account, and drawings means that the owner took money out of the business, which means that the owner's capital should go down. So we are going to debit Arbor's capital account with 8,000 for Arbor's drawing amount, again indicating that Arbor's capital decreases when Arbor withdraws money from the business. And if you look on your handout, you'll see that Barnett's drawings were 6,000, so we will debit Barnett's capital account with $6,000. And then the credits here are going to go against each individual partner's drawings account. And again, the reason is that this credit will zero out the drawings account, which means that next year the partner can start on a zero drawings balance. because drawings is a temporary account. This is all a discussion from chapter 4 of accounting 1, which is closing journal entries. So what we've accomplished here is to transfer each partner's share of net income to that partner, and we've also decreased each partner's capital account because of drawings that were taken out during the year, and furthermore we have managed to close off the drawings account. So we have done part A of this question. Now moving on to part B, we are asked to prepare the T accounts. Remember, the T account is like a ledger account, and it also helps us to understand the debits and credits. So all we are doing is posting, right? We thought about everything up here, so now we just need to post to the ledger. So the way I like to think of posting is copy and paste, because you don't need to change anything. However, do be careful of the fact that we have balances in these accounts. As the question says, right, Arbor has a beginning capital balance of 47,000 and Barnett has a beginning capital balance of 36,000. So our best bet is actually to include the balance in the account so that we don't forget about it. If we forget about it, then our answer is going to be wrong. Capital increases on the credit side, therefore the balance is also going to be on the credit side. That's the normal balance of the account. And then in order for us to actually have drawings amounts of 8 and 6,000, it must mean that there were balances in the drawings accounts. So we can include the balance for drawings for Arbor and include the balance for drawings for Barnett, so we know where we started. Now we go back up and we see how to post. We know that we have to credit each capital account, so we go down to Arbor's capital account and credit the account with the net income of 16,000, and we can also go to Barnett's account and credit Barnett's account with the net income of 16,000. Remember, you just copy and paste. Whatever you do in the journal, you do in the ledger. The signs don't change. And then going to the next journal entry, we see that we debited the capital accounts and credited drawings. So we do the same on our T accounts. We are going to debit the capital account for the drawings amount, which for Arbor is 8,000. We are decreasing Arbor's account because Arbor took money out of the business. And then Arbor's drawings account also has to be closed. So we are going to close the drawings account with 8,000. So what happens now to drawings? If we rule a line and we calculate the balance, what we'll see is that the balance on drawings is 0, right? I put the balance on the debit side because drawings has a normal debit balance even when it's 0. And for Arbor's capital, we have to do the calculation, right? Add these two credits and subtract the debit, and in the end we will get a balance for Arbor of 55,000 credit. Looking at Barnett, we know we are going to post Barnett's drawings debit of 6,000, and we are also going to close the drawings 6,000 on the credit side. Where does this come from? Well, I'm still working on the same journal entry over here, right? There were 4 accounts, so we need to post 4 different things. So ruling a line again for drawings and also for the capital account. As you can imagine, drawings is going to be 0, and the balance over here for Barnett is going to be a credit balance of $46,000. And that is how we allocate the income, prepare the closing journal entries, and also prepare T accounts for those journal entries to be posted. Let's move on to example 6 here. ESU company reports net income of 55,000. Partner salary allowances are Espino 15,000, Sears 5,000 and UTEC 5,000. Indicate the division of net income to each partner assuming the income ratio 50-30-20. Now there's a lot going on in this question. First of all, we need to pay mind to the fact that net income is 55,000. So that's all we have to allocate amongst the partners. What this partnership is doing is first allocating salaries to each partner and then saying whatever is left over will be split 50-30-20. So we have to go step by step to see what each partner will get. So get a clean sheet of paper or get your book out if it's not out already, and let's work through this example together. So I've set up a little income calculation sheet over here. Basically, it's just saying what is the income amount, which items are we allocating, and what is the total. Here's the names of each of the partners. So you can set that up for yourself as well. I'm going to put 55,000 in here as the income amount. The reason I'm doing that is it's easy to get carried away when we are allocating income and thinking that we should be doing more or allocating more income than what we actually have, right? So let's begin. The first thing to do is to allocate the salary allowances. The reason is that the partnership agreement obviously states what each partner should get as a salary, so we have to allocate that before we do the income ratios. So Espino gets 15,000, Sears gets 5,000, and UTEC gets 5,000, which gives us a total, if we add all three of these together, of 25,000. So we've already allocated 25,000 of the 55,000. So now what we do is we will allocate the remainder, meaning 55,000 minus 25,000, which is, hopefully we don't need a calculator for this, right? 30,000. So 30,000 is what's left over. And basically what our question said to us was Espino gets 50%, Sears gets 30%, and UTEC gets 20%. Again, Espino gets 50%, Sears gets 30%, and UTEC gets 20%. So let's see how we do that. So we'll say Espino's piece is going to be 30,000 times 50%. Right, so Espino is 30,000 times 0.5. That's what Espino gets. And then Sears is going to be the same 30,000 remainder, right, times the 30% given in the question. So it's 30,000 times 0.3. And then finally, UTEC is going to get 30,000 times 20%. This has to obviously add up to 100 so that we know we allocated everything. So 30,000 times 0.2. So there are the amounts for each of the partners. And if we look, we can see adding up the 15 and the 9 and the 6, we have in fact allocated 30,000. So let's just fix the formatting here so that we can see the numbers clearly. What we do now is go ahead and sum each column to see what each partner is allocated, and then also the total column to ensure that we have in fact allocated the appropriate amount. Do you notice that this 55,000 is the same, right, as the 55,000 of income that we had to allocate, which means that we have allocated everything. So Espino will get 30,000, Sears gets 14,000, and UTEC gets 11,000. And that's how we do an income allocation for partners with a salary allowance. Always remember that the number that you have in your total column at the end should be exactly the same as the income amount that you started with. For our final income allocation example, let's move on to example 8. This is Lee May Company. So it says here that Lee May Company reports net income of 57,000. The partnership agreement provides for salaries of 15,000 to Lee and 12,000 to May. They will share the remainder on a 60-40 basis, 60% to Lee Ali asks your help to divide the net income between the partners and prepare the closing entry. So what are you going to do here? Well, you know that 57,000 is what you need to allocate. There's also a salaries provision, and then finally you're going to do a 60-40 split with whatever is left behind. So let's go into a workbook or on a clean page and see what we can do. So I've set up a page here, our income amount. It's kind of a similar page to before. Our income amount is 57,000, right? And we know we have to keep that number in mind. Here's a space for items that have to be allocated. Ali's name, May, and then the total. So the first point that we need to deal with is the salary allocation. So there's a salary allowance, and for Lee it's 15,000, and for May it is 12,000. And so together those amounts bring us to 27,000. So the remainder is going to be again 57,000 minus 27,000. So coincidentally, and I guess to make the math easy for us, this remainder is the same as what we had in our previous example. However, here we only have two partners to share it with. So 30,000 times 60% for Lee. Remember, it said in the question that Lee gets 60%, so 30,000 times 0.6. And then May is going to be 30,000 times 40%. And so those amounts together, as we can see, add up to the 30,000 that we are trying to allocate. So, same as before, we will sum up each partner's allocation and the total to make sure that we are in line with what we started with, and we are 57,000. But there's one more piece to this question. It says to prepare the journal entry or the closing entry to allocate these amounts to the partners. So let's not forget about that. So I'm just going to do the journal entry below here because it will be faster. So debit, credit, right? And as before, we know that we use the income summary account, right, to allocate. So this is going to be our debit, and the debit is going to be the same 57,000 that we are trying to allocate. And then the credits for our partners will be each partner's capital account. So Lee capital, and Lee's capital will be 33,000, the same as what was allocated in the calculation. And then we've also got May's capital, and May will get the 24,000 as shown in the calculation. Together these add up to the same 57,000. And then all we are doing is allocating net income to the partners. And that's our journal entry, and that's how we allocate income. So we'll move into the next video where we'll talk about partnership financial statements, but for now this concludes our discussion on income allocation.